Ever felt like you're just drowning in information,
Ye-
trying to figure out what's actually real and who you can trust?
Oh, definitely.
Maybe you're looking at a company's big claims about, say, their user numbers or a nonprofit's report on their impact, and you just need to know, is this solid? Can I really rely on this?
Hmm.
Okay, let's unpack this. Today, we're doing a deep dive into something called attestation engagements and standards.
Sounds technical, maybe?
A little, but they're kind of the unsung heroes that build trust. They bring clarity to, well, everything from financial reports to operational stuff. Really important.
Yeah, and what's fascinating here is how essential these services have become. It really isn't just about auditing a company's main financial statements anymore.
Right.
Businesses, organizations, they need independent assurance on so much more. Think cybersecurity controls, sustainability efforts, all sorts of things.
Hmm.
So we're going to explore how CPAs provide that assurance, the specific rules they follow, the standards, and the different levels of confidence you can actually get from their reports.
And our mission for you, listening in, is pretty simple. By the end of this, you won't just know what attestation engagements are, but you'll really get why they matter. And crucially, how they offer different levels of assurance.
Yeah, different flavors of confidence, you could say.
Exactly.
Yeah.
So if you've ever wondered how companies prove their claims are trustworthy or, what those official-looking professional reviews actually mean, this deep dive is definitely for you.
And no accounting degree needed.
Absolutely not, we promise. So let's set the stage a bit. Why do these specialized services even exist?
Well, you touched on it. It really comes down to this growing hunger for independent, unbiased verification.
Yeah, there's just so much data flying around.
Exactly. And people need to know, is this reliable? Can I make a decision based on this? So at its heart, an attest engagement is basically when a CPA, the practitioner, the expert, issues a formal report. And this report is about a specific subject matter, or maybe more often, it's about management's assertion about that subject matter. The key thing is this subject matter. It's the responsibility of someone else, usually the company's management.
Right, so the CPA is the independent checker.
Precisely. You're bringing in an impartial third party to give their professional stamp of approval on something that isn't just your standard financial audit. Like, imagine a tech startup looking for funding.
Okay.
They might claim they have, say, 1 million active users, and a test engagement could be brought in to actually verify that claim. That gives investors confidence.
That's a great example. So the CPA can issue different types of reports you mentioned, an examination, a review, or agreed upon procedures.
Yep.
What's the core difference? Why pick one over the other?
That's
Yeah.
crucial. Because it tells you directly how much confidence you can place in what the CPA found.
Yeah.
So, an examination. Think of that as the deepest dive. It provides an opinion, and that comes with a high level of assurance. It's like a really meticulous, comprehensive check, almost like a full financial audit in terms of rigor. It's the gold standard, really.
Got it. High assurance.
Then there's a review. Now, this provides a conclusion, not an opinion, and a moderate level of assurance. It's less intensive. Think of it more like a significant sanity check.
Right.
The focus is more on whether anything looks wrong based on inquiries and analyses rather than proving everything is right.
So not quite as deep a dive.
Exactly. And then you have agreed upon procedures, which are, well, very different. Here, the CPA just performs specific tasks that everyone agreed on beforehand, like checking off items on a specific list.
Right.
And the report, it just gives the findings, the results of those specific tasks. There's no opinion or conclusion about the subject matter overall, just we did these things and here's what we found.
Okay, so it's very specific, very targeted, and no overall judgment call. Makes sense. It's all about the level of confidence needed.
Precisely.
Now, you mentioned the CPA is checking either the subject matter itself or management's assertion about it. Can you make that distinction really clear for us?
Absolutely. This really helps clarify what's actually being scrutinized. The underlying subject matter is the thing itself, the raw material, you could say.
Okay.
So, using our tech startup again, the underlying subject matter might be their raw user login data, just the records.
Right, the actual data.
Yep. Now, the subject matter information is the outcome or the claim that's derived from that data, measured against some criteria. So management's assertion that they have 1 million active users, defined as users who logged in at least once in the last 30 days, that would be the subject matter information.
Ah, okay, so the assertion is the interpretation or calculation based on the raw data.
Exactly. And the CPA might be checking that assertion. So are they verifying the raw stuff, or are they verifying someone else's claim about the raw stuff? It's an important difference.
Got it. That clarifies things. So with all these different situations, how do CPAs know what rules to follow? That's where the rulebook comes in, right? The SSAE.
Spot on. The Statements on Standards for Attestation Engagements, or SSAE from the AICPA. That's the professional guidance.
What kind of things do they cover?
Oh, a wide range. We've touched on some, but it also includes things like looking at financial forecasts and projections.
Okay. Future-looking stuff?
Exactly. Pro forma financial statements, too, those what-if scenarios.
Yeah.
Checking compliance with laws or contracts, even scrutinizing management's discussion and analysis,
Yeah.
the MD&A section in reports.
Right. The company's own story about their performance.
Yep. And also reports on controls at a service organization. Think like a payroll company handling your data. You want assurance on their controls. SSAE covers that too.
Wow, that's broad. And it's interesting how the reporting options differ. You said for agreed-upon procedures, it's just that specific report. But for things like forecasts or compliance or MD&A, you can get either an examination or a review. And for those service organizations, it's always an examination.
That's generally how it works, yeah. It aligns the level of assurance with the typical user needs for that subject matter. And just a quick note, you might remember preparations and compilations of forecasts used to be here.
Oh, yeah.
They've actually moved under a different set of standards now, called SARs. Just a little housekeeping detail.
Good to know. So maybe we can quickly clarify the different sets of standards just to keep things straight.
Good idea. So broadly, you've got SAS statements on auditing standards. That's for your traditional financial statement audits.
Okay, the main audit rules.
Right. And for public companies, it's the PCAOB rules, which are based on SAS. Then you have SR statements on standards for accounting and review services. That's mainly for preparing, compiling, or reviewing financial statements for private companies, non-issuers.
Got it. SRs for non-issuer financials.
And finally, SSAE, our focus today. That covers all these other specialized attest engagements we've been talking about. They each have their own lane.
Okay, that helps map it out. So what doesn't SSAE apply to? Because people might assume it covers everything a CPA does.
Right. Good point. It doesn't cover traditional audits under SAS or PCAOB rules.
Yeah.
It doesn't cover those SRs engagements, prep, compilation, review of financials.
What?
It also doesn't cover preparing tax returns, or if a CPA is acting as an advocate for you in court, like litigation support, or general consulting and advisory services.
Right, so your tax person isn't doing an SSA engagement.
Exactly. And it also doesn't apply to audits of internal controls over financial reporting when those are integrated with a financial statement audit. SSAE's domain is really specific. Independent assurance on stuff that isn't historical financial statements or on non-financial information.
That's a key distinction. So now that we know the types of engagements, let's talk about the standards themselves, the quality control aspect. What do these attestation standards actually do?
Well, they provide the essential framework, right? The quality guidance, the objectives for CPAs doing these broad services. They ensure consistency and professionalism.
And how do they compare to, say, the auditing standards, GAS?
They're definitely broader in scope than GAS because they apply to such a wider array of subject matters.
Okay.
But they don't supersede GAS or SRs. They live alongside them. And conceptually, there are some key differences. SSAE standards don't specifically reference historical financial statements or generally accepted accounting principles, GAAP, like audit standards do.
Interesting. And you mentioned something about tailoring these services.
Yeah, that's a really neat feature. Attestation services can often be tailored to what the user actually needs. The user might even participate in defining the scope of work or the criteria being used.
So it's more collaborative sometimes.
It can be, and this often results in what's called a limited use report, meaning the report is specifically intended only for certain parties who understand that context and participate in setting it up.
Makes sense.
And like other standards, there's a hierarchy. You have the mandatory requirements in the SSAEs themselves. Then interpretive guidance, like official interpretations or AICPA guides, which CPAs should really consider. And then other non-authoritative stuff like articles or training materials that can be helpful but aren't required reading.
Okay. Now, to help us remember the core principles that apply to all these different attestation engagements, you mentioned a mnemonic.
Cape Corp.
That's the one.
Great.
Cape Corp.
It's a handy way to remember the foundational elements. It's not just a checklist. It's really the professional backbone ensuring these reports are trustworthy.
All right, let's break it down. C.
C is for compliance. Pretty straightforward. Follow all the relevant attestation standards. If, in a rare case, you have to depart from a standard, you must perform alternative procedures to meet the objective.
Okay.
A is acceptance and continuance. This means the CPA firm has to have policies to decide if it's appropriate to take on or continue with a client relationship in a specific engagement. Are there any issues? Can we do the job properly?
Makes sense. Due diligence up front. PT.
P is for preconditions. Before you even start, certain things must be in place.
Like what?
Well, the practitioner needs to be independent, unless some law specifically requires the service anyway, which is rare. The responsible party, usually management, must accept responsibility for the subject matter.
Okay.
The subject matter itself has to be appropriate, and the criteria used to measure it must be suitable. The CPA has to expect they can actually get enough evidence to do the job. And crucially, the output must be a written report. Can't just be a verbal, okay.
Right. Needs to be documented. E.
E is engagement documentation. Standards for how the work papers and records are prepared, kept safe, how long they're retained, who owns them, and ensuring confidentiality.
Got it. Next A.
Second A is acceptance of change. If the terms of the engagement need to change midstream, that change has to be reasonable and justified.
Right.
You can't just change scope willy-nilly. U stands for using the work of another practitioner. Sometimes part of the work might be done by another CPA or expert. That's allowed. But the main CPA has to do their homework on the other practitioner. Check their independence, competence, ethics, the quality of their work.
Right. You're still responsible.
R is responsibility for quality control. The engagement partner, the lead CPA on the job, is ultimately responsible for the overall quality, making sure the team follows ethical rules, is competent, the work is reviewed properly.
The buck stops there. And the final P.
Final P is professional skepticism and professional judgment. These have to be exercised throughout the entire engagement. Always questioning, always critically assessing the evidence, using expertise to make informed decisions. Absolutely fundamental.
TB Corp.
Yeah.
That's actually a really helpful way to frame those core requirements. It definitely highlights the rigor involved.
Mm-hmm.
Now let's shift gears slightly and talk about risk. Specifically, for examinations and reviews, there's something called attestation risk. What is that exactly?
Yeah. Attestation risk is basically the risk that the CPA messes up. It's the risk they issue an inappropriate opinion or conclusion when the subject matter or the assertion about it is actually materially misstated.
Okay, so the risk of giving the wrong answer, essentially.
Pretty much, yeah. The risk of saying something's okay when it's actually got a significant problem, or vice versa, though that's less common.
And importantly, this risk concept doesn't apply to agreed upon procedures, right?
Exactly right. Because with AUPs, the CPA isn't giving an opinion or conclusion, they're just reporting findings from specific steps. So the concept of issuing an inappropriate conclusion doesn't really fit.
Okay, so for examinations and reviews, how does this attestation risk break down? I know in auditing there's a similar model.
Yep, very similar structure. It has three components. First is inherent risk.
Okay.
This is the susceptibility of whatever you're looking at the subject matter to a material misstatement, assuming there are no related controls. It's like, how tricky or complex or prone to error is this thing naturally?
So it exists regardless of the company's checks and balances.
Exactly. It exists independently of the engagement. The CPA assesses this risk, they try to understand it, but they can't change it.
Got it. What's next?
Second is control risk. This is the risk that a material misstatement that could occur won't be prevented or detected and corrected on a timely basis by the company's own internal controls.
Ah, so this is about how good the company's own systems are at catching problems.
Precisely. Like inherent risk, this also exists independently and the CPA assesses it. Now here's where it gets really interesting. If the CPA assesses control risk as low, meaning the company's controls seem strong and effective, they might be able to rely on those controls.
And do less testing themselves.
Potentially, yes. Stronger controls can mean less need for the CPA to perform extensive, detailed, substantive procedures later on.
Okay, that makes sense. It's like the detective analogy. Inherent risk is how messy the crime scene is naturally. Control risk is how good the building's security system was.
Perfect analogy.
So what's the third piece? The detective's own work.
Exactly. That's detection risk. This is the risk that the procedures the CPA performs won't detect a material misstatement that actually exists and that wasn't caught by the internal controls.
So this is the risk the CPA can control.
Yes. This is the one they manage directly. They adjust the nature, timing, and extent of their attestation procedures to control this risk. If they want less detection risk, meaning they want to be more certain they find any existing misstatements they need to do more work, more rigorous testing.
Okay, so they ramp up their own efforts if the inherent or control risks seem high.
That's the idea. The overall attestation risk, which they want to keep low, is essentially the product of inherent risk times control risk times detection risk. They assess the first two and adjust their work to manage the third to get that overall risk down to an acceptable level.
That really clarifies how those pieces fit together. So moving towards the end product, the report, how are these actually issued? Is it always about the assertion?
Good question. The report can be issued in two main ways. It can be on the assertion that management or another responsible party makes, or it can be directly on the subject matter itself.
Okay.
For most assertion-based engagements, examinations, reviews, AUPs, the CPA generally gets a written assertion from the responsible party. That's the norm.
But not always.
Not always. In what's called the direct examination, the CPA doesn't get an assertion beforehand. Instead, they directly measure or evaluate the subject matter against the criteria themselves and report on that.
Interesting.
And if the CPA finds material misstatements or issues during any engagement, exam, or review, their report has to be modified. And in that case, their conclusion or opinion would typically be expressed directly on the subject matter, explaining the problem.
So what happens if there are problems, like the assertion seems off or it doesn't meet the criteria or the disclosures aren't good enough?
Yeah, those situations require modifying the report. For an examination, significant issues could lead to a qualified opinion, meaning it's okay except for this specific issue, or even an adverse opinion, which is basically saying, this is materially misstated, it's not okay.
That sounds serious.
It is. For a review, similar issues would lead to a modified conclusion, indicating where the problems lie.
And what about scope restrictions? Like if the CPA can't get the information they need?
That's another big issue. For an examination, if a scope restriction is significant, it could result in a qualified opinion or a disclaimer of opinion where the CPA says, we couldn't get enough evidence to form an opinion at all, or they might even have to withdraw from the engagement.
Wow. And for a review?
For a review, if they can't perform necessary procedures due to a scope restriction, the usual course is for the CPA to withdraw. They generally can't issue a report if they couldn't do the planned work.
Okay, that really highlights the importance of cooperation and access to information. All right, let's really try to visualize these engagement types now. Looking at how the reports differ might really cement the assurance levels. We've got assertion-based examination, direct examination, and review.
Okay, let's start with the assertion-based examination. Remember, this gives you a positive opinion and high assurance. The CPA does a lot of work searching, verifying, inquiring, analyzing, similar depth to an audit.
Right, the gold standard.
And the key here is that management, or whoever is responsible, provides that formal assertion about the subject matter, like, our system uptime met the 99.9% criteria. The CPA then gives an opinion on whether the underlying subject matter actually meets the criteria, or they can give an opinion directly on management's assertion itself.
So the report language would be pretty confident.
Yes, very positive. You'd see phrasing like, in our opinion, the company's assertion regarding X is fairly stated in all material respects based on the Y criteria. Or, in our opinion, the company's system uptime met the 99.9% criteria. High confidence language.
Got it. Now the direct examination, still high assurance, right?
Still high assurance, still a positive opinion. The big difference, remember, is the CPA directly measures or evaluates the subject matter themselves against the criteria.
No assertion upfront from management.
Correct. Management doesn't provide that specific assertion to be tested, but they do still have to acknowledge their underlying responsibility for the subject matter itself. The CPA takes on the measurement role.
So the report would sound slightly different.
Yeah, it would reflect the CPA's direct role. It might say something like, we have examined the company's cybersecurity controls. In our opinion, the controls were suitably designed and operated effectively based on the Z framework. It emphasizes the CPA's direct evaluation.
Okay, clear distinction. And then the review, lower assurance level here.
Right. A review provides limited assurance, sometimes called moderate assurance, and it results in a conclusion, not an opinion.
Limited assurance conclusion.
But the work is less extensive. Typically focused on inquiry, asking management questions, and analytical procedures looking for unusual trends or relationships, though other procedures might be used too. The goal isn't to confirm everything is right, but rather to see if anything comes to the CPA's attention suggesting that material modifications should be made to the information or the assertion for it to be in line with the criteria.
Ah, the nothing came to our attention idea.
Exactly. The report language is key here. You'll see phrases like, based on our review, we are not aware of any material modifications that should be made to the accompanying assertion or subject matter information for it to be in accordance with the criteria. That phrasing is the signal of limited assurance.
And the report explicitly says no opinion is given.
Yes, it will clearly state that the work was less in scope than an examination and therefore an opinion is not expressed.
Okay, so that really raises an important question. Why would a company choose a review? If an examination gives higher assurance, why not always go for that? Seems better.
It often comes down to a practical trade-off: cost and time. Examinations are more thorough, so they naturally take more time and consequently cost more. A review is typically less costly and quicker to perform.
So it depends on what the users of the report actually need.
Precisely. If the stakeholders, maybe internal management or a specific third party, only need that moderate level of comfort, a review can be a very efficient and perfectly appropriate choice. Not every situation demands the highest level of assurance.
That makes perfect sense. It's about matching the service to the need. So let's quickly summarize those assurance levels one more time, just to lock it in.
Good idea.
Examination. You get reasonable assurance, which is high. It results in a positive opinion. And it feels similar in rigor to a traditional audit review. You get limited assurance, which is moderate. It results in a negative conclusion like nothing came to our attention. And it feels similar to an SR's review of financial statements. Agreed upon procedures, you get no assurance regarding the subject matter overall. You just get a list of findings based on the specific steps performed. Not really comparable to an audit or review in terms of assurance.
Perfect summary.
Okay, one last critical point. You mentioned earlier that written assertion. How important is that really?
Oh, it's generally crucial. For assertion-based examinations, reviews, and agreed-upon procedures, the CPA normally requires a written assertion from the responsible party.
Why written?
It formalizes exactly what is being claimed or stated about the subject matter against the criteria. It avoids misunderstandings. The CPA then uses their professional judgment to evaluate if management even has a reasonable basis for making that assertion. They don't just take it at face value.
Okay, so what happens if management just won't provide one? If client is the responsible party?
That's usually a major problem. It's considered a scope limitation. So, for an examination, if the client responsible party refuses to provide the assertion, the CPA generally has to either withdraw from the engagement, if possible, or issue a disclaimer of opinion. They can't give a positive opinion.
Okay, and for a review?
For a review, they should withdraw. If withdrawal isn't possible for some reason, they'd have to modify the report to explain the situation and restrict its use.
And AUPs?
For agreed-upon procedures, the CPA would still issue the report on findings, but they'd have to modify it to describe the scope limitation, the fact that the assertion wasn't provided.
What if the client isn't the responsible party?
Yeah.
Say the client hired the CPA to check something another company is responsible for.
That's a bit different. If the responsible party, not the client, refuses to provide an assertion, the CPA might still be able to issue a report if they can perform sufficient procedures and get enough evidence otherwise. But the report must disclose the fact that the responsible party refused to provide the assertion, and the report's use must be restricted to the specified parties who understand that context.
Okay, so that assertion is a pretty big deal.
It really is. And beyond that, there are just a few other general requirements worth mentioning quickly. Things like documentation, keeping good records, similar to audits or reviews.
Right.
Establishing an understanding with the client about the engagement, preferably in writing through an engagement letter. Getting a representation letter from the responsible party at the end of examinations and reviews, confirming certain things.
Great.
And making inquiries about subsequent events, things that happen after the period covered by the engagement but before the CPA issues their report, could impact the conclusions.
And if we connect this back to the bigger picture, all these rules, the assertion, the documentation, the inquiries.
Exactly. They're all designed to safeguard the integrity and the ultimate usefulness of the information that you, the user of the report, are relying on. It's all about building that trust.
What a journey. Seriously, we've covered a ton of ground here.
Right.
From, what these attestation engagements even are to the subtle but important differences in assurance levels and reporting, all the way to how CPAs manage risk and the quality controls, like Kid Corp, that underpin everything.
Yeah, and hopefully it's clear how these services really fill a crucial gap. It's not just audits anymore. They provide that needed independent check on this huge, growing range of information that's just vital for making good decisions today.
Absolutely. Which leads us to our final provocative thought for you, our listener. Given this explosion of new kinds of data, think about detailed sustainability reports, ESG metrics, even the need to audit AI algorithms for fairness or bias. How do you think attestation services will need to evolve? How will they change in the next, say, decade to keep pace with this world that just keeps demanding more trust and more verified information?
That's a big question.
Definitely something for you to mull over as you continue your own deep dives into the topics that matter most to you. Thanks so much for joining us on this deep dive.
Been a pleasure.
Until next time, keep exploring.